Well, when global markets blew up again this week, the banks pretty well copped the full force of the blast. Indeed, the world's bankers seem to be lurching from one crisis to another. For his take on things, I spoke to ANZ Chief Mike Smith, who, despite producing an increase in profit and a generally optimistic trading update on Friday, saw his share price hammered. Well, Mike Smith, a Swedish financial regulator, said this week that the interbank market is once again vulnerable to freezing up. Do you think that's true?
It's certainly become much less liquid, and I think that what has been happening internationally is that there has been definitely an increase to quality. We saw it first with the Italian banks being pushed out and the French banks, and then a couple of the American banks came under pressure. But the good thing that has happened so far, which is unlike the crisis in 2008, is that the interbank market has continued to work.
Bank shares have been getting smashed, though, not just in Europe, but everywhere.
Yeah, that's the equity markets, but the debt markets actually for us are far more important. If those markets freeze, then obviously things do become much more difficult. But so far, that's continued to work.
And it turns out the Federal Reserve is now investigating European banks, particularly in their operations in the US. But do you think that's possibly a bit dangerous because nobody really wants to know what's under the covers there?
Yeah, I think we all probably know what's under the covers, but I think the issue was probably a little difficult in its timing, and has certainly exacerbated a degree of volatility. I think the European banks were sort of just getting over that first crisis of confidence, and they sort of stabilised that, and this has created another little problem.
But do you think that the European banks are actually solvent?
Well, I mean, I think that they're all in a position where they have sufficient capital right now in terms of their actual operating business. But of course, most of them are returning ROEs of less than their cost of capital. So in terms of sustainability, it is an issue. But of course, a number of those European banks are already supported by the government, and as we know, they do have a tradition of standing behind their banks.
You mentioned in your update this week that it's a changed world post-GFC. Now, one aspect of that, of course, is the relative decline of America and Europe versus Asia, and you're taking advantage of that with your push into Asia. But another way is that everyone wants to be a depositor now, not a borrower. And I just wonder the extent to which that is changing banking, and how are you responding to it?
Well, I think that's not necessarily a bad thing. And I think particularly for the Australian banks, who have traditionally always been long loans versus deposits. So in fact, this if you like, this balance of movement of savings is actually benefiting the Australian banks. And certainly our assets to deposit ratio has actually been reducing, which is a good thing.
So again, it leads to low credit growth, doesn't it? I mean,
it does,
the volume of your business is not growing as much as it was.
That's true in the sense of how the balance sheet would grow. But I think what people tend to forget is that banks actually make money on both sides of the balance sheet. There is a spread on deposits as well as a spread on loans. And therefore, if you structure your liabilities, your deposits properly, you can actually do very well out of that. And actually growing them is equally important to growing your loans.
Yeah, but is that true in Asia? I noted that I think you said that you're not taking deposits anymore in Asia.
Well, we're very liquid. We have almost 50% more deposits than we have loans in Asia.
So does that mean you're having to park the difference in low-yielding assets?
No, what you do is just price it out. So it's not a problem. It's a nice problem to have if it was a problem.
But I note that ANZ shares got hurt a bit more than the rest of the banks on Friday, and
a little bit maybe.
Well, just talking to the analysts, the feedback was that there's more concern about ANZ's opportunities for growth than the other banks. Do you feel that sort of pressure?
No, I don't. Well, the analyst community look at all sorts of things, but not many of them have ever run banks. So I'm comfortable with where we sit. We have a very clear strategy. We're moving on the path or on the journey on that strategy. We're delivering against what we said we would deliver, and I think our opportunity is huge.
Tell us about how you see the opportunity. What is the opportunity?
Well, the opportunity for banks in this part of the world is obviously that connectivity to Asia. The growth of the world is going to be driven by the two engines of China and India in the foreseeable future. Now, Australia is incredibly well linked into that connectivity. Connected into that region. It is part of our region, and therefore, as we expand into that, we take the opportunity from that expansion of those economies. So that's our upside.
But you've talked about being patient and doing it sort of almost organically, I think.
Yeah.
But surely there must be some opportunities coming up to grow more
Well,
rapidly.
We're always looking out for opportunity. I think it is important that you maintain your disciplines in terms of acquisition. And I think any strategy has to be based on organic growth. That makes sound sense. As I said today, I think organic expansion is one time's book. That's always a good place to be.
But I think there are some banks around the world, I don't know about in Asia, that are priced at less than one time's book.
Yeah, there are not so many in Asia, unfortunately. That's in Europe at the moment. You can buy a bank and get one free, but that sort of thing is not quite the case in Asia. The quality of assets are better.
In Australia, you've been cutting your fixed rate mortgages quite hard. Is that because you're looking to win back some market share?
No, I think we're just seeing a niche in the market there. There has been a sort of demand for fixed rate. It's quite a nice product to have because you can actually fix your funding of it quite clearly, so you can lock it in, and so it's just really an opportunity. At the moment, we are trying to maintain our market share in mortgages. We're growing.
How's that going?
Well, it's going well. I mean, we grew a bit too fast at the beginning of the year. Then we came off a little bit, and now we're going back. And I think we'll end the year at or around system growth, or maybe slightly higher. And that's where I wanted to be.
We're just back to the problem of low credit growth. Perhaps it's not so much of a problem, but how do you adjust a bank's settings to take advantage of that?
Well, I mean, it's not all about credit growth, because I think if you look at the Australian banks over the last 20 years, I think you'll see that there has been perhaps too much dependence on the net interest margin in terms of their total earnings. They're close to 70% of total earnings. You would actually expect in a bank which is probably a little bit more well structured to have about 50% of earnings in non-fund income and 50% in fund income. So that's where we're trying to move, but it will take us time to do that.
By fund income, you mean
in the net interest margin?
Yes.
Yeah. So it's not only about the balance sheet. It's also about the other products that actually you're trading and that you're using, which don't use balance sheet. Because at the end of the day, balance sheet requires capital. So really, the thing that you should be trying to do is to utilise your capital as efficiently as possible.
But all those areas that don't require capital have proved to be, in Australia, particularly very competitive.
Yeah,
and
but
part of the reason the banks here are relying so much on net interest margin is because the banking business is not so competitive.
No, I don't think so. I think if you look at the cross-sell opportunities within the institutional bank, the commercial bank, and the retail bank, it provides quite significant opportunity. I think what has happened is that because credit growth has been so high year on year on year, people have just been able to ride that wave. So they haven't needed to perhaps expand the business and look for the opportunities in terms of a bigger cross-sell.
Thanks for joining us, Mark Smith.
Thanks, Alan.